which now becomes interesting because we've got the borrowing costs facing banks in New Zealand now actually quite a bit higher than the Reserve Bank would have been expecting. And with the most recent round of increase, especially in the 1 and 2 year fixed mortgage rates, well, those interest rates are actually now sitting at higher levels than the Reserve Bank had adjudged were all that was needed in order to get inflation under control in New Zealand. Well, hello again, everybody, and welcome to my weekly video, having a look at some of the options for the home buyers out there when it comes to managing your mortgage, and I guess some of the fears that people have about what interest rates are going to do. It's been interesting over the past 2 to 3 months when we've had, from back in April, the Reserve Bank pretty much saying they were happy where mortgage rates were sitting, and indicating that the only reason they actually took the official cash rate back then up to 5.25%, it's 5.5% now, was basically to stop interest rates from falling. And there was downward pressure on New Zealand mortgage rates back then, 2 to 3 months ago, because we saw overseas a lot of optimism about inflation falling in the United States predominantly. We saw those US medium to long-term interest rates coming down, and they have quite an influence on New Zealand medium to long-term fixed interest rates. But what we've got now is exactly the opposite happening. Over the past even 2.5 months, we've seen some reasonably sharp increases in some of those United States interest rates, predominantly in response to the indicators for their labour market turning out to be a lot stronger than anyone was expecting. Now, that's just led to some worries, not so much about inflation going back up again, but that it's going to be harder to get it back down to 2% than people were thinking. There's this view that maybe inflation overseas is relatively sticky. So there's a very strong, or now strengthened, expectation that we're going to see US interest rates go up another 2 to 3 times. It's led to their rates rising for the likes of 2 to 5 year fixed interest rates, and that's fed through to where we are here in New Zealand, which now becomes interesting because we've got the borrowing costs facing banks in New Zealand now actually quite a bit higher than the Reserve Bank would have been expecting. And with the most recent round of increase, especially in the 1 and 2 year fixed mortgage rates, well, those interest rates are actually now sitting at higher levels than the Reserve Bank had adjudged were all that was needed in order to get inflation under control in New Zealand. And the thing is, when we economists look at some of these leading indicators of inflation out there, we can see that monetary policy is definitely having an impact here in New Zealand. We can see that inflation expectation measures are going down. So this is how much people expect inflation will be in 1 2 years time, etc. We can see the proportions of businesses saying they plan to increase prices further dropping away as well. And the primary means by which the Reserve Bank wants to crush the economy, get inflation down through high interest rates, consumer spending, we can see that that is definitely falling away. And in my most recent monthly survey of consumers, my spending plans survey, I've just released the results, it shows a net 38% of people plan cutting back on spending over the next 3 to 6 months. There is no real improving trend as yet. So you see, if I was sitting at the Reserve Bank, I'd be thinking, yep, monetary policy is working, and there's going to be more disinflationary, downward pressure on inflation, pressure that's coming through, as the retailers are going to still do it pretty tough for the remainder of this year. The question is, are we at a point yet where the Reserve Bank is prepared to say, maybe things are too tight, we think we will cut the interest rate? I would say no. Now, I'm recording this 2 days ahead of the Reserve Bank's review of the official cash rate, so hopefully not going to be proved tremendously wrong there. Like most other economists, I expect that for this week, their comments are going to be relatively bland, but they will note that things are going in the right direction. Personally, I'm still running on an expectation that the first easing of monetary policy by the Reserve Bank won't come until some point in 2024. And before we get into that year, I hope to have a view on whether that's going to be January or December, because this far out, frankly, you definitely cannot tell. If I were borrowing at the moment, I personally still would be in the likes of the 1 year, maybe to 18 months fixed interest rate area. It would probably suit me best, expecting to be able to ride down falling interest rates, certainly in my belief, over the second half of 2024 into 2025. So hopefully going to get that forecast right out there. We'll see how it comes. These remain exceptionally uncertain times. All the best out there.